Today's video is going to challenge how most people are thinking right now because a lot of attention is locked onto silver, gold, and precious metals, and almost nobody is asking the more important question, what happens next? Silver has exploded into mainstream conversation. Search interest is at extreme levels, headlines are everywhere, and price action looks aggressive and emotional. And whenever you see that combination, extreme attention, emotional conviction, and straight-line price movement, that's usually not the beginning of a move. That's often the later stage of it. I'm not saying silver is dead, and I'm definitely not saying it collapses tomorrow. What I am saying is that this kind of environment is exactly where capital rotation starts to matter more than price itself. One of the most important lessons markets teach, and one that most people ignore, is that money doesn't disappear, it rotates. It moves from one narrative to the next, from one asset class to another, usually following fear first and opportunity second. Silver and gold are classic risk-off assets. People rush into them when confidence in currencies, governments, or stability starts to weaken. That's not controversial, and that's how they've behaved for decades. But what almost nobody talks about is what happens after that fear trade becomes crowded. Right now, silver is no longer a quiet hedge. It's a popular trade, and popular trades come with risk, not safety. When everyone is already positioned, the upside becomes limited while volatility increases. That's not opinion, that's market mechanics. Straight-line price action is never sustainable, and history is brutally consistent on that point. Every asset that moves vertically eventually corrects, consolidates, or rotates attention elsewhere. And this is where things get interesting, because when capital starts exiting a crowded risk-off trade, it doesn't go back to cash and sit there forever. It looks for the next place where growth, liquidity, and asymmetric upside exist. Historically, that has meant technology first, and in more recent cycles, digital assets shortly after. This isn't about hype. It's about understanding how investors behave when fear transitions into opportunity seeking. A lot of people make the mistake of looking at silver, gold, tech stocks, and crypto as separate, unrelated markets. They're not. They're connected through liquidity and psychology. When confidence shifts, capital moves up the risk curve. We've seen this pattern before multiple times. Precious metals move first during uncertainty. Then once that trade becomes crowded and starts to stall, capital rotates into higher growth assets that benefit from easing conditions, stimulus, or renewed optimism. And here's the uncomfortable truth most people don't want to hear. By the time everyone is euphoric about an asset, the easy part of the move is usually already behind them. Late entrants don't get rewarded for conviction, they pay for it. Markets punish emotional certainty. That doesn't mean silver can't go higher in the short term. It means risk is rising, not falling. And rising risk is exactly what smart money watches for when preparing for the next phase of a cycle. This is why understanding timing matters more than chasing narratives. So the real question isn't, is silver strong? The real question is, what does a crowded silver trade set up next? And that's where this conversation shifts toward technology, liquidity, and digital assets, and eventually toward XRP. Not because of price predictions, not because of hype, but because of positioning within a broader macro transition that has played out before and is quietly setting up again. In this video, I'm going to walk you through the historical patterns most people overlook, explain how capital rotation has worked in past cycles, and break down why this period could matter far more for what comes after silver than for silver itself. If you're only watching price, you're already late. If you're watching behavior, you're early. Let's break this down properly. Now, to really understand why this moment matters, we need to slow down and properly unpack what's actually driving the silver move. Not the headlines, not the excitement, but the mechanics underneath it, because this is where most people get trapped. They confuse cause with effect. Silver hasn't been rallying in a vacuum. This move is happening against a backdrop of macro uncertainty, currency debasement fears, geopolitical stress, and declining trust in long-term monetary stability. In environments like this, investors don't suddenly become bold. They become defensive. They look for assets that feel tangible, historically respected, and psychologically safe. That's why silver and gold always show up early in these cycles. They benefit first from fear, but fear trades have a shelf life. Right now, silver is no longer just a hedge quietly doing its job. It's become a story, a popular one. Search interest is extreme, social media sentiment is emotional, and price action is aggressive. That combination matters more than most people realize. When an asset becomes a consensus trade, the risk profile changes completely. Upside no longer comes from new information. It comes from greater and greater emotional commitment. And that's a fragile foundation. Another critical point that gets overlooked is sustainability. Markets can trend, but they cannot move vertically forever. Every time an asset goes into a parabolic phase, it creates imbalance. Liquidity thins out. Late buyers pile in. Early buyers start thinking about protecting gains. And eventually, even a small shift in sentiment can trigger sharp pullbacks. This doesn't require a catastrophe. It only requires exhaustion. We've seen this exact setup countless times across different asset classes. When people start saying this time is different, that's usually not a signal of strength. It's a signal of complacency. Silver is behaving right now the way many assets behave near local extremes. Conviction is high, caution is low, and corrections are being dismissed as impossible. That mindset never ends well. What makes silver particularly important in this discussion is what it represents. It's a risk-off asset. People move into it when they want protection, not explosive growth. That's fine, until the protection trade becomes crowded. Once that happens, the question shifts from how do I protect capital to where can I grow it next? And that's where rotation begins. Capital rotation is not random. It follows a logic. Investors typically move from cash to safety, from safety to growth, and from growth to speculation. Silver and gold sit early in that chain. Technology and digital assets sit later. When fear peaks and begins to stabilize, capital naturally looks up the risk curve. Not all at once, but deliberately. Another mistake people make is assuming this rotation only happens after crashes. That's not true. Often it begins while prices are still high, just no longer accelerating. That's why tops are usually processes, not events. Distribution happens quietly, volatility increases, confidence starts to fracture beneath the surface, even while headlines remain bullish. This is why watching behavior matters more than watching price. Search interest, positioning, sentiment, and narrative saturation tell you more about where an asset is in its cycle than a single green candle ever will. And by those measures, silver is no longer early. No. Again, this does not mean silver collapses tomorrow. It means the risk-reward balance is changing. And when that balance shifts, smart capital starts preparing for the next move and not reacting after it happens. So if silver is moving from a fear trade into a crowded trade, the logical question becomes, where does capital go when fear starts giving way to opportunity? Historically, that answer has pointed toward growth, innovation, and liquidity-sensitive assets. And that's exactly where the conversation starts to move away from precious metals and toward technology and eventually toward digital assets. In the move forward, we're going to step back and look at history because this pattern isn't new. It's repeated itself more times than most people are willing to admit. And once you see it laid out clearly, it becomes very hard to ignore. Now let's move forward and look at history because this is where most people either wake up or completely miss the setup. Markets love to repeat behavior, even if the headlines change. Different decades, different assets, same psychology. When we study silver rallies in the past, we start to notice something very important. Silver usually moves first, but it almost never holds the spotlight for long. Let's go back to the late 1970s. Silver experienced a massive rally driven by supply issues, inflation fears, and extreme speculation. Prices went vertical, confidence was high, people truly believed the move would never end. And then reality stepped in. The rally collapsed and silver entered a brutal correction that lasted years. But here's the part most people ignore. While silver was falling apart, capital didn't vanish. It moved. Within months, technology stocks began to gain traction. That period marked the early foundation of a multi-year tech expansion. The lesson wasn't that silver failed. The lesson was that silver finished its role in the cycle and capital rotated into growth. Fast forward to 2008. During the financial crisis, silver rallied as fear dominated markets. Investors wanted protection. Once again, silver moved early. But after the panic phase passed and stimulus entered the system, capital rotated. Technology stocks recovered strongly, and over time, digital innovation accelerated. The fear trade ended and the growth trade began. Then we saw it again in 2011. Silver exploded higher, driven by inflation concerns and currency uncertainty. It felt unstoppable. But that rally peaked, corrected sharply, and what followed was another powerful period for tech stocks. The Nasdaq entered a multi-year bull market shortly after. Same behavior, different year. And then there's 2020. This one is especially important because it directly connects precious metals to crypto. Silver rallied first during uncertainty, Then, as liquidity flooded the system and risk appetite returned, capital rotated aggressively into digital assets. Bitcoin, Ethereum, and eventually XRP all benefited from that rotation. The timing wasn't random. It followed the same structure we'd already seen before. Here's the key insight most people miss. The delay between silver peaking and growth assets accelerating has historically been months, not years. Sometimes it's quick, sometimes it takes a little longer, but in almost every case, it happens within a relatively short window. That's why people who wait for confirmation often arrive too late. Another important point, silver tops are not single moments, they are processes. Volatility increases, momentum slows, confidence cracks quietly. By the time everyone agrees the move is over, capital has already started positioning elsewhere. This is why watching price alone is dangerous. Price tells you where an asset has been. Behavior tells you where it's going. And right now, behavior looks very familiar. Every major silver rally in modern history has eventually been followed by a rotation into higher risk assets. Not because silver is bad, but because its job in the cycle is temporary. It absorbs fear. Once fear fades, opportunity takes over. So when people ask whether this time is different, the honest answer is the assets may change, but human behavior doesn't. Investors still chase safety first. They still chase growth later, and they still underestimate how fast rotations can happen. Understanding this doesn't mean you perfectly time tops or bottoms. It means you stop being reactive. You stop chasing headlines. You start thinking in phases instead of prices. And once you start thinking in phases, it becomes much easier to understand why attention is slowly shifting away from precious metals and why technology and digital assets keep re-entering the conversation. Now that we've seen how this pattern has played out before, we can move forward and talk about what this means in today's market and why certain digital assets may be positioned very differently than people expect right now. That's where this really starts to get interesting. Now let's move forward and bring this into today's market, because this is where theory turns into positioning. If we accept that capital rotation is a real thing, having history clearly shows that it is, then the logical question becomes simple. Where does money go when it leaves a crowded safety trade like silver? It doesn't jump randomly. It moves toward areas that benefit most from improving liquidity, easing financial conditions, and renewed risk appetite. That's where technology and digital assets come back into focus. When fear starts to cool and uncertainty stabilizes, investors stop asking, oh, how do I protect my money, and start asking, where can my money grow? This shift in mindset is subtle at first, but incredibly powerful. And it's exactly the environment where higher risk, higher reward assets begin to outperform. Crypto sits much further up the risk curve than silver. That's why it doesn't move first. It moves after fear trades peak. And within crypto, not all projects benefit equally. Capital doesn't flow blindly. It looks for narratives tied to real-world relevance, infrastructure, and long-term utility, especially in later stages of a cycle. This is where XRP enters the conversation. XRP has always behaved differently from purely speculative crypto assets. It doesn't rely solely on hype or novelty. Its narrative is tied to payments, liquidity, and financial infrastructure, themes that tend to re-emerge when markets shift from protection mode into growth and efficiency mode. That doesn't guarantee price appreciation, but it does mean XRP often gets attention when the conversation moves towards systems, not memes. We've seen this before. In the 2020 cycle, capital rotated from precious metals into crypto as liquidity flooded the market. Bitcoin and Ethereum moved first, but XRP followed as attention expanded beyond store of value narratives into payments and utility discussions. That rotation didn't happen overnight, and it didn't happen evenly, but it followed a clear progression. Another important factor here is timing. Many people expect immediate results. That's not how rotations work. There's often a window where prices look quiet, boring, or even disappointing while positioning is happening behind the scenes. This is where impatient investors lose interest and where patient ones quietly prepare. Right now, digital assets are still largely ignored by the same mainstream audience that is obsessed with precious metals. That matters. Opportunity usually exists where attention is lowest, not highest. When everyone is already convinced, the upside is limited. When skepticism dominates, the setup improves. That doesn't mean you blindly buy everything. It means you focus on assets that align with where capital historically flows after fear trades unwind. Assets connected to liquidity, infrastructure, and technological adoption tend to benefit the most when conditions shift. XRP sits in that category, whether people like it or not. It continues to be part of conversations around cross-border payments, settlement efficiency, and financial rails, areas that matter more during periods of economic transition than during pure speculation. So the question isn't, will XRP explode tomorrow? That's the wrong way to think. The better question is XRP positioned to benefit if capital rotates the way it has in previous cycles? And based on history, behavior, and narrative alignment, it's hard to ignore that possibility. As we move forward, the final thing we need to address is expectations, because this is where most people either protect themselves or get burned. Understanding opportunity is one thing. Managing risk and realism is another. That's what we need to talk about next. Everything we've discussed up to this point is about structure, not certainty. History does not give guarantees. It gives tendencies. And the biggest mistake investors make is turning tendencies into promises. Markets don't reward that kind of thinking. Silver may top soon, or it may stay volatile longer than expected. Capital rotation might begin quietly, or it might take time to become obvious. No one rings a bell at the top. No chart flashes a warning sign that everyone agrees on. That's why positioning always feels uncomfortable when you're early, and obvious when you're late. What history does show is that extreme moves in fear-driven assets are usually followed by opportunity elsewhere. And the investors who benefit are rarely the loudest or the most emotional. They're the ones who prepare while attention is still focused somewhere else. This is where expectations need to be controlled. If you're looking for overnight results, you're already setting yourself up to fail. Capital rotations don't work that way. They unfold in phases. There are quiet periods, there are fake-outs, there are moments where nothing seems to happen at all. That's normal. That's part of the process. When it comes to digital assets like XRP, the opportunity is not about predicting a specific price or date. It's about understanding where an asset sits within a broader macro shift. Assets tied to liquidity, payments, and financial infrastructure tend to matter more when markets move from fear toward efficiency and growth. That doesn't mean every project wins. It means selectivity matters. Another hard truth most people avoid: even if the setup is right, execution still matters. Overexposure, emotional trading, and unrealistic expectations can ruin a good thesis. This is why patience and risk management matter just as much as analysis. You don't need to catch the exact bottom. You don't need to sell the exact top. You need to avoid being on the wrong side of the cycle. If silver does begin to unwind and capital starts rotating the way it has in previous cycles, digital assets will likely re-enter the conversation. Whether XRP benefits will depend on timing, liquidity conditions, and how narratives evolve, not on hype, not on social media excitement, and not on blind conviction. So the real takeaway from this video is simple. Stop chasing what already moved. Start understanding what tends to move next. That mindset alone puts you ahead of the majority of market participants. And before we wrap up, I need to be very clear. Nothing in this video is financial advice. This content is for educational and informational purposes only. Markets involve risk, and you should always do your own research, consider your own financial situation, and make decisions that align with your personal risk tolerance. If you take anything from today, let it be this: clarity beats hype, preparation beats reaction, and patience beats prediction. That's it for today on Journey to XRP. Stay sharp, stay rational, and I'll see you in the next one.